about how their quarterly performance has been. Harsh, good to have you on ET now. Thanks for your time today. I was just going through your operational performance, Harsh, and your PAT has declined over 14.5% this quarter. Elaborate on the key factors behind this earnings pressure and whether you think this is going to even persist going forward, or is it just a one-quarter anomaly that one has seen?
Good morning and thank you. Before I answer your question, let me take a step back and give you a broad overview as to what it has been in the last quarter. First of all, we gained market share both in deposits as well as in advances, and today we are the 6th largest private sector bank. Now, if I break down our performance in terms of deposits, advances, and on fee, there are some operational parameters where the bank has done considerably well. If you look at the advances, it grew by 3% quarter on quarter, while the yield on assets fell by about 27 basis points. However, you must note that the repo cut has been 100 basis points. So there has been a lot of effort in terms of containment, in terms of drop in yield. And please also note that Federal Bank upfronts the passing of or the transmission of the repo cut on a T+1 basis. So that has an impact. But more heartening to note is also if you look at the cost of deposits, that has actually gone down by 20 basis points in the last quarter, which has been by repricing on the savings bank account and a deposit cost also coming down. CASA has actually grown by 12%, and the CASA ratio itself has actually improved by 12 basis points to 30.35%, which has kind of bucked the industry trend where we have largely seen banks reporting falling CASA ratio. So this is on the deposit side. If you look at fee, the last 1 year has shown a growth both in fee and other income by 20 and 22%. So if you look at these three parameters, the operating profit has actually shown a growth of about 6% quarter on quarter. The impact, which is where now I'm coming to the point which you are referring to, was regarding the fall in net profit, and that has largely been in terms of provisioning or asset quality. Now, before I jump and give a broad guidance on the asset quality, let me divide this into two parts. The first part is in terms of the microfinance and agri portfolio, which has got impacted. As you would be aware, the microfinance portfolio at large across the industry has been severely impacted, and that had a bit of a dent on our quarter. But if I look at the non-agri, non-MFI portfolio, it has largely remained stable the way it was, and we don't see any concerns over there. But because of the accelerated provisioning, which we adopted from Q3 of last financial year, this has resulted in a PAT impact. Now, on asset quality, let me also clarify. In terms of MFI, we have seen the peaking of the slippages and asset quality dip in the month of May. June has been better than May, and July, what we have got early indications, seems to be better than June. So we do believe that it should get better from here.
All right. Okay. But why such a rise in provisioning? I mean, is there something that you foresee right now? Because it's quite a significant extent. And do you really see provisioning levels normalize then in future quarters?
Okay. So if you recall that we had adopted accelerated provisioning from Q3 of last year, because of which we provide fully within 180 days, 50% on 90 days and another 50% on 180 days for our unsecured book. That has an impact. However, if I look at a guidance or what we have been referring to for this financial year, that our slippages would be broadly, credit costs would be broadly about 55 basis points, and we kind of stand by that part. So we do believe that Q2 in terms of asset quality will be better, but there will be a provisioning impact which comes with a lag, which like what I told you, what we saw slippages in Q1, you will have an impact in Q1 and a little bit in Q2 as well. So while I do expect asset quality to improve from Q2 onwards, the provisioning should also start coming down from Q3 onwards. So our guidance in terms of credit cost remains at 55 basis points, which we had guided for at the beginning of the year.
All right. Hi, morning. This is Shrishti also joining in, but talk to us specifically on the margin front, because your NIMs, if I say, that has declined for 2 consecutive quarters. If you can help us analyze that, what were the factors that are at play, and going ahead, what's the outlook for NIMs? Can we expect some more recovery in this number, or they could just be at these levels for some time now?
So typically in an increasing interest rate scenario, there's a benefit of NIM which comes in. Similarly, when we go down interest rate path, when it's being cut, the deposits gets repriced with a lag, whereas advances gets repriced almost immediately. Our external benchmark linked loan books, which is at about 48% and has been coming down, gets impacted almost on a T+1 basis. And hence the impact of 100 basis points cut has almost been fully felt. The last cut by the RBI when they announced it was over 50 basis points, which was felt again in the Q1. It's not been fully impacted. Now, how do I see NIMs going forward? While we do see a pressure on NIMs in Q2 and somewhat moderating from Q3, Q4 onwards, because the benefit of low cost of deposits will start kicking in more from Q2 and fully from Q3, Q4 onwards. That's one part. Secondly, we have done a couple of things which will help us in terms of containing or managing our NIMs. One is the CASA mix, which I mentioned at the earlier part of the call. Our CASA ratios actually improved by more than 100 basis points, almost 108 basis points year on year. And this, if we continue, will have an impact in terms of the lower cost of funds. Secondly, we have reduced our savings banks rate by 50 basis points in 2 cuts, which will also give its benefits coming to it. The fixed deposits repricing typically happens over a period of time, and which we will see playing out in Q3, Q4. So as of now, do we see a pressure on NIMs? Initially, yes, about 5 to 10 basis points can be there, but eventually from Q3, Q4 onwards, we would see start improvements in that as well.
Okay, so that's the outlook on NIMs, but Harsh, if we talk about your cost to income ratio, that has come in at almost 54.9%, higher than your earlier guided figure of anywhere between 53 and 53.5. Help us understand what were the key cost drivers this quarter, and also if any changes in guidance for the coming quarters, maybe a slight bit of an upward revision.
Okay, so our cost to income actually came down by about 180 basis points over Q4, but yes, on YOY basis, as you rightly mentioned, was higher. 2-3 factors. One, our cost to income has got impacted because we have been front loading certain costs which we are very conscious about. A brand campaign which you will be seeing on the TVs also has resulted in an impact because we chose to upfront that in Q1 itself. Secondly, tech related costs and certain manpower costs, we have chosen to take it upfront, and hence it was elevated. We have been guiding for a cost to income of around 54%, and we kind of feel confident that it would be there. The other factor which also does impact cost to income is the cut in repo, and the resultant fall in NII till it stabilizes also has a bearing. So I would expect the cost to income to be around 54% levels, and we should see improvement over the medium term. As of now, we are investing on certain costs which we believe that it will benefit the bank in the medium to long term, and hence we do not want to cut down on those costs.
I want to talk about your slippages as well, Harsh, because they're up 34% sequentially, 56% on year-on-year basis. What sectors are witnessing pain, and any sort of silver lining to the clouds anytime soon? Any improvement that you anticipate?
So if you look at the slippages factor from our total book of microfinance, which actually constitute about 1.5-1.6%. Microfinance, JLG and SHG, this whole constitutes of micro assets, is about 1.5%, so nothing very substantial for the bank as a whole. But this, if you notice, the industry as a whole is going through a significant challenge. While we do believe that we are better in terms of asset quality in microfinance compared to industry, but there's always a contagion effect, which is what has impacted the MFI sector. But if I look at the non-agri, non-MFI piece, our slippages have actually remained more or less the same compared to what it has been for the last 4-5 quarters. And we are reasonably confident, while we are seeing a little bit of talks that the MSME sector will get impacted, some parts of retail unsecured, but our asset quality, barring a few basis points here or there, has remained largely stable. And microfinance in particular, like I mentioned, we saw the peaking of the slippages in the month of May. June was lower, July is yet lower. So we are optimistic that this should get better from here in terms of asset quality and slippages in the microfinance.
And given that 20% of your MFI book is from Karnataka, are things stabilizing there? What's the visibility going forward?
So Karnataka has been a concern, as you rightly mentioned, and our largest portfolio was in the state of Karnataka. While it's a diversified portfolio, But in that portfolio, Karnataka and South was actually, if you look at a year and a half back, South was a better performing geography. So we do follow a pattern where we want to be geographically diversified. Karnataka in particular seems to have stabilized or getting better from this quarter onwards, last quarter, towards the end of last quarter. I won't say the pain is fully behind, but we do expect things to get better from here for Karnataka.
All right, and along with that, if we see your credit cost for the quarter, that was at 67 basis points, where as your guidance, if I believe, for FY26 stood at 55 basis points. Will you change your guidance, or do you expect the credit cost to come down going forward?
Yes, we are both hopeful, optimistic, and reasonably confident that we should be able to continue at 55 basis points.
Okay, so that's the outlook over there. But before we let you go, also help us understand a little bit more on your asset quality in terms of your GNPA and NNPA. They've both slightly risen this quarter. Help us understand where have you seen the pressure and what's the outlook going ahead?
So if I look at the corporate portfolio, the wholesale portfolio, I think it's among the best in the industry and remains so. In terms of the other segments, if I look at the unsecured credit card, personal loans, commercial vehicles, auto loans, personal loans, has remained largely stable. On the MSME side, while we do hear a little bit of a stress, as of now, we have no reasons to be concerned about it at this point in time. The only place and area which I've been mentioning is a little bit on the agri and largely on the MFI sector. And MFI also, we are reasonably optimistic at this point of time because of the early indicators which we are getting from the market and from our book also, that it should get better from here. So if I have to slice the whole book of the bank, 1.5, 1.6% of the microfinance portfolio is definitely an area of concern. But this has been, like I mentioned, an industry-wide phenomena. And we do see, in microfinance also, we do believe that our asset quality has been better in the industry, but there's always a contagion effect because if a large segment of the microfinance borrowers do not pay up to other lenders also, it's a matter of time they will not pay to other banks also. But I do believe that the industry outlook itself seems to be improving. The industry as a whole had contracted in the last 3 quarters, or rather 4 quarters, I would say, every quarter, which has also put pressure on these borrowers. I do see green shoots and lenders coming back to this segment and the asset book probably growing in from Q2 and Q3 onwards. So I do believe that the sector as a whole will also improve. And within that sector, we as a bank are relatively better placed and things should get better from here.
Okay, Harsh, thanks so much for taking the time out and speaking to us this morning and throwing some light on the quarter that you've seen and also what we can expect from the quarters coming ahead. Thanks a lot.
Thank you.